Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Simon Mott, Chief Marketing Officer at TrackInsight, to discuss ETF trends and what they indicate for how investors are approaching inflation. Simon, it's great to see you again. Welcome back to Trade Talks.
Jill, good to be back. Thanks for having me again.
You got it. And inflation is back on the table. What are the ETF markets telling us about how investors are reacting?
Yeah, I mean, inflation is back on the table. It's actually back on the menu. It's been reflected in many ways, and I think it's a very tangible thing. A lot of what we talk about in finance is difficult for people to understand, but I think inflation is one of those things that people recognize very, very quickly, and it's being manifested in many, many different ways. We see this in the increase in price in your shopping basket and your shopping trolley when you do your groceries every week. Businesses, most famously like McDonald's, are having trouble hiring because of wage inflation, and people are expecting more amount of money for their time. So this is not just affecting the consumer, it's affecting businesses as well. And interestingly, the US seems to be suffering significantly from this at the moment, with the inflation rate around 4.2%. When we contrast this to my home territory here in the UK, we're seeing inflation around 1.2%. So US consumers, US businesses have a lot of challenges to face in the coming months. Now, the ETF markets are reactive, and they are moving quickly to respond to this new environment. And what we're seeing in the treasuries market particularly is a continued sell-off, particularly in the short-dated treasury bond markets. And frankly, who can blame investors when they see the year-to-date returns, which are flat, if not slightly negative? The flows have been moving out of this sector consistently over the year, and we see no change in this over the last month. Particularly in the 0 to 1 year space, we still see redemptions. We still see people cashing out of that market. And so the fixed income market is really telling you a big story there. When you look at the flip side of that, which is the tips, we see people are loading up on protection. So people are getting defensive, and significant flows, not just this year, but in the last couple of weeks, into Treasury inflation protection swap products, with billion-plus flows in some cases into some products. The returns there have been far more positive than they have been in the fixed income markets. So what we can see is investors are taking a defensive position. They see inflation coming, and they're repositioning their portfolios, particularly within the fixed income space, to adapt to this new environment.
In inflationary times, investors often gravitate to more tangible assets. Do ETF flows reflect that trend?
Yeah, absolutely, Jill. We see a couple of sectors which are typically seen as friendly in a high inflation environment. When we look at financials, energy, real estate, and consumer staples, we see the markets really behaving in the way that you would have expected. On the performance side, all of these sectors are positive over the last month, and some of them have been seeing really significant inflows. Financials particularly have seen more than $3.5 billion worth of additional flows come their way in the last 30 or so days. And the other sectors like energy, with about $500 million, real estate, about $500 million as well, and consumer staples, people loading up on these more defensive sectors. So what is impressive about this is it illustrates how educated the ETF market is around inflation, and people are making good decisions about how to allocate their money.
And Simon, to wrap up here, gold is a well-known inflation hedge, and Bitcoin has been touted as having similar qualities. Are there any noticeable trends you're seeing there?
Yeah, well, it's a fascinating comparison because, gold has been around for many thousands of years, and Bitcoin is such a new innovation, and people like to conflate the two asset classes, but they're very, very different in their characteristics. But it's certainly true that gold has got its shine back, and we're nearing a 3-month price high on gold. And we see that even though year-to-date flows are generally negative, that trend has been reversing over the last month or so, with investors increasingly going towards this defensive asset class. Some of the larger ETFs have seen significant flows, although it must be noted it's not consistent across every single provider. Now, this could be because people are choosing a particular product over another, but what we certainly have seen is a reversal of the downward trend in gold buying to a more positive attitude towards gold. Bitcoin, however, is an entirely different world, and I think this has been fantastically illustrated over even the last week, where we've seen very, very headline-driven, emotionally driven reactions to Bitcoin, and the price movements have been fantastically volatile. What that means is for an investor who wants to take a Bitcoin position, they're welcome to do that, but they need to really consider whether that's an effective inflation hedge or whether it's merely a diversification option for their portfolio. And flows are really varying by the region and also by the issuer. And so it's difficult for us to pinpoint whether or not there is a significant trend in Bitcoin. But what we see anecdotally from TrackInsight, and we speak to a large amount of professional investors around the world, is that many of them who've had a cryptocurrency or a Bitcoin exposure are now seeing the volatility in the market, seeing this inflationary concerns coming their way, and they're migrating from some of those high volatility asset classes, some of those more traditionally defensive asset classes like gold. So for your listeners, I'd ask them to question whether or not Bitcoin is really an effective volatility hedge, or whether it has the same characteristics that they've probably been loving for the last few months, which is high volatility, high trading opportunities, and the potential ability to catch upside after the dip. So I think gold and Bitcoin, even though they're touted in the media as having equivalent characteristics, really don't, and it's up to the investor to understand the different potential that gold has as a physical commodity versus Bitcoin as an intangible cryptocurrency.
All right, Simon, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.